Hey everyone, I'm Jono and welcome to Trading with Master Jack. In this video, we're going to be discussing the truth about interest earning investments. We're going over number one, which is inflation and future value of money and why that is important to take into consideration. Number two, investment costs and tax implications, how that can affect your ultimate earnings from your investments. Number three, we're going to have a good example about our actual gain, where we can see what our realized interest is at the end of the day. So stay tuned. Now on to number one, inflation and future value of money. Inflation in terms of economics, it is a general increase in prices and fall in the purchasing value of money. $1,000 today does not have the same purchasing power as $1,000 in 1 year or even in 5 years. One of the most straightforward examples of inflation in action can be seen in the price of milk. In 1913, a gallon, which is approximately 3.78 liters, of milk cost about 36 cents per gallon. 100 years later, in 2013, a gallon of milk costs $3.53. That is nearly 10 times higher. Now, what determines inflation? That would be the CPI, Consumer Price Index. This is done by measuring the cost of purchasing a fixed basket of consumer goods and services of constant quality and similar characteristics. The products in the basket are selected as being representative of households' expenditure during a year or any other specified period, but it's generally a year. The rate of inflation is the percentage change in the consumer index from 1 year to another. So if in 1 year the price index is 104.1 and a year later the price index has risen to 112.5, then the annual rate of inflation can be calculated as follows. You take the 112.5 minus the 104.1, and that you divide by the 104.1 and times it by 100 to get the percentage value. That is just working out the general price increase for between two numbers, and that would equal 8.07%. Now, just to take this a step further in the terms of our $1,000 purchasing power, therefore $1,000 a year back has the purchasing power of $919.3 today. So that's now going on year, if the inflation had increased by 8.07%. So that is why it is important not just to maintain the purchasing power of your money invested, but also to grow it above the inflation rate. Otherwise, there's no real growth in your investment. I mean, what is the objective at the end of the day for having your investment? Now on to number two, investment costs. The type of costs to look for when making your investment decisions. Asset management fees, fund manager fees, also known as the fund manager fee or service fee. This is the charge levied by an investment manager for managing an investment fund. This fee can be a fixed fee or a performance-based fee. In other words, rewarding a manager for outperforming a predetermined benchmark, or a combination of the two. The asset manager fee is typically expressed as a percentage charged annually and covers the costs of running the unit trust. However, there are more costs related to the management of an investment fund. And in order to make these clearer to investors, these are now stated as part of the total expense ratio, TER, and will be published on fund fact sheets. So it's important to look for that, as that can give you the overall view of the costs. There's financial advisor fees. These are the fees paid to financial advisors for advice, which will either be upfront or ongoing. Fees paid to a financial advisor are for professional services rendered in the same way that any other profession charges for advice, similar to a lawyer. Warren Ingram, the executive director at Galileo Capital, says there are typically three ways that financial advisors charge clients. Now, we've gone over number two of them so far: asset management fees, financial advisor fees. But it's important to compare fees. Now, when comparing costs, it's important to compare apples with apples. Now, thankfully, this is becoming easier for most savings products like unit trusts. The costs are typically disclosed as a total expense ratio, as mentioned previously. This figure, an industry standard, and one that is published on fund fact sheets, Includes expenses such as management fees, including performance fees, fixed operating costs such as audit fees and bank charges, and quite often the value-added taxes. Also very important for that to be included overall, because after all, you still do pay VAT to some degree on products, as investment funds are products at the end of the day. Now, it's also important to take into consideration tax implications. It is important to ask what type of taxes you pay when your investment is realized. That's basically when your term finishes. Now, typically with fixed interest investments, you have interest tax, or simply you taxed as income tax. Now, understanding this is important, as it is different from country to country. And those are basically the three important expenses to look at: is management fees, fixed operating costs, and value-added taxes. There are also interest-earning investments that are tax-free in several countries. So it's also good to look at those, but then of course take into consideration the total expense ratio. Now for the fun part, example time, looking at your realized interest. So say we're looking at investment product ABC, which offers us an interest rate of 5% annual interest on the investment. It's a fixed deposit. The investment cost is 0.5% of the total investment, or we could say it was the total expense ratio is 0.5%. The term would be 12 months. Now, other variables to take in consideration. In this example, we have a tax on interest earned of 18%. Now, of course, we're just using this straightforward as 18% on interest earned, but in some countries that use or charge interest tax, they would work on a bracket system of sorts, where a certain amount is exempt and then you only pay a certain amount above a certain amount. So yeah, and the current inflation rate is 4%. So here's your investment of $10,000. Your fund manager fee, or TER, 0.5% of that is $50. So then your actual investment is actually $9,950. Your interest earned after 12 months, $497.5. And your interest tax, the tax on the interest, 18%, is $89.55, which then results in a total payout to you of $10,357.95. Now your realized gain then is $357.95, which is 3.58% compared to the 5% that you were signing up for. So there you can really see how costs can impact your investment. But there's one more thing that we have not taken into consideration, and that would be, that's right, inflation. So inflation is 4%. How does your realized gain match up to that? Well, overall your investment has actually devalued by $42.05, which is 0.42% less after the 12-month period. So this shows you a good picture in terms of the value of your money and what you should look at in terms of the costs, the inflation, and what type of interest rates you should be hunting for, that they are realistic and overall can still grow your money and protect it still from inflation. So in conclusion, take into consideration, number one, inflation, all the costs from the broker, the total expense ratio, and any tax implications that there may be. So there we go. And in my next video, a follow-up to this one, I'm going to have a video called The Real Hack of Compound Interest. And there we'll be going over compound interest, which is effective interest rate, and also what investment is needed to live off interest only. And just as an extra for as a trader focus, how does compounding apply to a trader? A trader who trades in Forex or CFDs, in stocks and indices and commodities. Because traders tend to be always focused on massive gains, but taking the concept of compounding into consideration, that is really ultimately not needed and should not be the goal then, because then it's about consistent gains, and not big gains, but consistent gains. And they also illustrate the power of compounding. If you enjoyed this video, hit that like and subscribe button so that you don't miss out. Happy trading, and may the trend be with you.